Let's take a look at Chapter 7. Chapter 7 is about stocks and corporate valuation. So think of ways to value what a company is worth is really what the chapter is about. So some of the highlights we'll talk about are right here. The features of a common stock, how to value a common stock, how to value a company using free cash flow, and then also the preferred stocks. We'll talk about those. So where we're at, the arrow's drawn to the area up above and down below. So the value of operations is basically what they call the free cash flow method. And that's the FCF that you see up here. So what we're saying is the value of a company is the present value of all future cash flows, and that's the infinity symbol there. So all future cash flows till the end of time of the company, divided by 1 plus the WACC, and the WACC stands for weighted average cost of capital, which is up and coming. We're going to get to what that means in more detail later on. But the WACC is basically just think of the cost of funds that the company needs to go out and invest in itself, invest in new operations and new opportunities, new product lines, facilities, locations, and so on. It's just what is the cost of obtaining those funds is what the WACC is. So that's one way to value a company, value the operations. Not every company pays dividends, so this method works quite well. At the bottom, then, is the value of the stock. In this example, is the value of all dividends from now until the future divided by 1 plus R. R sub S is the required return on the stockholders' equity of the company. Very similar to the WACC, but more focusing just on the return on equity as opposed to basically the cost of capital. So both formulas, they have different letters, but they're really doing the same thing. So that's what I want you to kind of recognize is both methods are valuing a company based on the present value of future cash flows. Not every company pays dividends, so the free cash flow method works for companies that don't pay dividends. The value of the stock one down here does work quite well when a company pays dividends. Okay, so what is common stock? If you don't recall from previous classes, no problem. It just represents ownership. Now, ownership means with a stock, it implies control. Now, if it's a publicly traded company and you own some shares, it doesn't mean you get to make management decisions. It's not like that. Because instead, what you do is you have the right to vote for the board of directors. And the board of directors then is kind of acting as your proxy or as your agent to represent your best interest as a stockholder to make sure that management is doing what they're supposed to do to make the company profitable, hold upper management to making good decisions, hold them accountable to making good decisions, and so on. So managers are agents of shareholders, and basically they have to work through the board of directors. Okay, so it says here, as agents of shareholders, the goal should be to maximize stock price. That's always the goal. So it's always best if you can kind of think of what's the main theme of a particular class. And it's very simple for this class. Learning the ways that companies can use to make themselves more profitable, to make them worth more. So to increase stock price, maximize value. That's really what we're kind of focusing on here. So classified stock, stock is always classified. A company typically when they first begin to offer stock and go public, they might have Class A, but down the road they might issue Class B, Class C. It's just up to them how much they want to offer, how many different classes they want to offer, and so on. Some companies, as a way to repay the founders of the company, make sure that they still have a lot of control after the company goes public, will receive what they call founder shares, which have voting rights, but dividend restriction. So founder shares typically are like super votes. Those votes count more than a Class A, Class B, Class C share. If you heard the term IPO, that stands for initial public offering, that's when shares first are offered from the company to the public, and the public buys those shares from the company. A tracking stock, it works like a stock of a particular company, but instead of being tied to the results of the entire company, instead is tied to the results of a particular division of the company. So basically we're saying that this works when you can value a division and it can kind of stand on its own. Typically the stocks have no voting rights. And really, it's just the division that you're focusing on, but not many companies do this. Okay, so we can value stock a few different ways. I've mentioned the free cash flow method. And within that method, we might have what we call the constant growth formula or the non-constant growth formula. It just depends on what we think the future cash flow patterns will be for a company. And then we use the dividend growth model, same thing, constant growth or non-constant growth. And then another method we can use is called the multiples of comparable firms. So what I could do is I would look up a company and a publicly owned one, and I could look at like earnings per share and basically find a multiple of earnings. How much are people willing to pay for a dollar of earnings of a company? That'd be my multiple. And if I'm looking at a privately owned company, basically I'm just looking at a public company that does the same thing as a privately owned company and saying, well, a company like you that's publicly traded, its stock trades at a multiple of X, whatever that amount is. And so you can kind of apply that to another company as a way, as a proxy for evaluation. So the main three methods to value a company: free cash flow, dividend growth, and the multiples. Okay, so free cash flow is the first one we'll take a look at. So when you see FCF in any of your reading and the slides, it just stands for free cash flow. And the WACC is the weighted average cost of capital. So free cash flow, the definition, it's the cash available for distribution to all of a company's investors, okay, generated by operations. Now, so obviously a well-run company that's performing well will generate free cash. That's the whole point. And once you begin to generate free cash, the thought is then we can use that as a valuation of the company. And free cash basically just means cash we can take out and not negatively impact the operations of the business. So we still need to keep cash on hand to reinvest in the business as machinery and equipment wears out or breaks down. You need to have cash available for emergency funds, for opportunities to take advantage in the marketplace, to launch a new product line, buy out a competitor, something like that. So it's all the cash above and beyond that that can be returned to investors. And that can be returned to investors through dividends, stock buybacks, owner draw if it's a privately held company, anything like that. And the weighted average cost of capital is the rate of return required by all company investors. And think of it as literally the cost of raising capital. So, and capital comes from, for a corporation, comes from issuing stock, and that could be common or preferred stock, borrowing money, which is debt, and using your own retained earnings as a way to fund future growth. So it's kind of a combination of all of those, and we'll get into that in a future chapter. So this is the formula for the value of operations. Now it looks kind of crazy, but I promise you it's not that bad. And we'll just kind of break this down into what this all means. So VOP is simply value of operations. The letter E, looks like the letter E, it's called the sigma. That's the sums formula. And we have the sideways 8 at the top, which is the infinity symbol. And so what we're saying is the future cash flows to the power of time divided by 1 plus the WACC to the power of time equals my value of operations. Okay, so that's what the formula works. Now we'll use other methods to go value that. So don't get hung up on oh man, I got to be able to crunch this formula. Don't worry about that. If you understand how to get to the components, we can use some other tools to calculate it for us. Okay, so we're trying to figure out what is the sources of value for a company. And we're going to break out sources of value into two different things: the value of the company's operations, okay, and then the non-operating assets. Just things that the company happens to own that have value, but are not actually used in the day-to-day operations. So a lot of companies, they take extra cash and they just park it in accounts to gain a little bit of value, like short-term investments, marketable securities. It's very common that if you cash flow very well, you're just taking the extra cash and just literally investing it to just get more return. It's also common that you would have what they call a non-controlling interest in another company. You may have a small minority share of stock of a supplier or somebody that you sell to, or just other companies. And so the value of non-operating assets is usually close to what's reported on the balance sheet. So what we can usually do is just look at the company's balance sheet and go, what's the amount for short-term investments, marketable securities, ownership of non-controlling interests, and just say, those will be really close to market value. And so we're just going to be okay using those from a company's balance sheet. So the main challenge is how to value operations. Okay. Now, there's always a claim to a corporation's value, and those claims are debt holders first. So just imagine if the company were to go bankrupt, who's in line to collect? Well, debt holders are first in line, so they have first claim. So we're just going to say the value of operations is a certain amount, but we have to take money away from that to represent that the company would have to pay back debt, and then also that preferred stockholders would also have to get repaid. So anything left after that belongs to the company stockholders. So we're thinking common stock. So typically then, on the left-hand side, this is kind of a common value chart for most companies. The vast amount of value of a company is based on the value of operations. Only a small section is really based on non-operating assets, what we'll call marketable securities, short-term investments. On the right-hand side is basically the claims. And so equity is the owner's equity of the business. Think stockholders' equity. And that's common stockholders' equity. Then we have debt and preferred stock. And preferred stock is usually pretty small, and not every company has preferred stock. You don't have to have preferred stock. You do have to have common stock, though. Okay, so here's my formula, and obviously doing this for every future year seems kind of onerous. So it's, conceptually that's what we're doing, but how do you find the present value of an infinite stream, right? That's like, how do I do that? If I'm assuming this company will be around forever going forward, how do I go about doing that? So what we're going to do is assume a growth rate. And so G is the growth rate for a particular company. So it says, what's the value of operations if FCFs grow at a constant rate? And that's the formula that we can use to help figure this out. So this formula here is basically just saying, let's just make an assumption and say, we believe that all future cash flows will grow at a certain percent, whatever that percent is. And that makes this formula way easier to go about and calculate. So I want you to notice it says value of operations 0. Always think in finance, when we talk about 0, we mean today. And then 1 is just some point of time, one period from now. Now we kind of automatically think 1 year, right? It just says time 1. I mean, it could in reality be a month or something like that. But it's just kind of safe to say, just imagine that's 1 year. So FCF1 is my future cash flows a year from now, and divide that by the WACC minus my growth, and L is just on stock L. Okay, so think of that today. So the value of operations today is based on next year's free cash flow divided by WACC minus a growth rate. Okay, so that's what they call the constant growth formula. Now, it's not a perfect formula because it only works if the WACC is greater than the growth rate, right? If you flip that around, you get a negative, and you can't divide by a negative. So the WACC must be greater than the growth rate. Okay, now I want you to notice that this formula says FCF1, and this formula says FCF0 times 1 plus the growth rate. So I want you to recognize that FCF0 times 1 plus the growth rate is the same thing as FCF1. So if you can kind of just remember that and pick up on that, that'll be helpful. I'm mentioning that to you because in the homework, they will give that to you a couple of different ways. Sometimes they'll say, here's FCF1. Sometimes they'll say, here's FCF0, and the growth rate is X percent. So sometimes you have to calculate FCF1. Sometimes they just give it to you. And so they're going to walk us through an example, and you have examples in your chapter also. So the FCF0 is 24 million. The WACC is 11. We expect a growth rate of 5%. Short-term investments are 100 million. That's 200 million. Preferred stock is 50. And the number of common shares floating around that investors own is 10 million. So we can plug in our numbers to our formula. We can go FCF0 was given to us. They said 24 million times 1 plus the growth rate becomes FCF1, which is what the formula requires. And then I take the WACC of 11 minus the growth rate of 5, and I get a $420 million valuation on my operations. Okay, so that's the starting point for what my company is worth. So I take that 420 million, and I add to that the value of my marketable securities, short-term investments. So the total value of my company is 520 million. So now I've got my value. I subtract from that the claims to that value. Well, the first claim is debt. The second claim is preferred stock. So what's left over is the value of the stockholders' equity. Think common equity, 270 million. And I divide that 270 million by the 10 million shares that common stockholders own, and that gives me a price of $27 per share. So P0 is the price of my stock using the free cash flow method, constant growth. Okay. Now, what happens if we have non-constant growth, which might be a very common thing also? So let's just say in this example, in year one of a company, we actually predict negative cash flow, which is not unusual in early years of a business. In early years, the business is going to actually be using up cash and not providing cash. Obviously, the goal is to get through that so the company does begin to produce cash at some point in the future. So in year one, $10 million of cash is a negative. The company is going to eat cash instead of providing it. In year two, it goes to 20, then 35, and so on. And then at some point, we generally have to come up with a growth rate. So we're going to predict that in years 1, 2, 3, there's not a constant growth rate. There's going to be an irregular pattern. But then we're saying after year 3, we would expect a 5% growth rate. And it says here in this example, we're going to keep the WACC the same at 11, marketable securities, debt, preferred stock, and number of shares of stock, all the same from the previous example we just looked at. Okay. So this one's a little bit tougher to do because each of the 3 years that wasn't a constant growth, I have to value independently. And so it just becomes a little bit tougher until I get to the constant growth amount. So here's kind of the pattern of cash flows then. So recall in year one, I have a negative 10. In year two, a positive 20. Year three, a positive 35. And then I begin my constant growth after that. So that's the pattern I have to look at, the timeline I have to look at. So what I have to do is figure out what's the value of operations starting with years 3 to 4. From years 3 to 4, I begin my constant growth, called the horizon value, sometimes called terminal value or continuing value. All those words work the same. Okay, so here's my horizon value, HV, which is my value of operations both in year 3. So in year 3 to 4 is when I go constant. That's why we're using 3. And so I've got my 35 times 1 plus the growth rate of 5, my WACC of 11 minus 5. I get 612.50. So the value of my operations from years 3 going forward, I believe is 612.50. Okay, so here's the pattern of my cash flows then. So I've got year 1, 2, and 3 already figured out. So, the negative 10, the 20, and the 35. And then I've now done the horizon value of years 3 to infinity. And so I have to bring all these back to today times 0 at present value. Okay, so now I've got numbers here, 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 and here. And I bring those all back to times 0 using time value of money. So then I have to kind of think back to the present value chapter that we did. And this is the timeline of what we have. So I've got in year 1 a negative 10. I bring that at 11% as the WACC. So basically just think the present value of negative 10 at 11% for 1 year is 9.009. The present value of $20 at 11% for 2 periods is 16.232. Present value of 35, 11%, 3 years, 25.592. Then finally, over here in year 4, I've got the value of operations from years 3 forward, and I have 612.50, and I bring that down to today at present value of an amount, 612.50 from 4 years at 11%, I get 447.855. So now my value of operations is 480.67. I then go through that same exercise I did before. I add the short-term investment, subtract the debt, subtract the preferred stocks, divide by the number of shares, I get a price of 3307. So it's more challenging, right? There was more steps to do there, but it's still doable. So the constant growth formula is way simpler. The non-constant growth obviously more challenging. So just kind of be aware. They're kind of just showing how that all worked out. So just giving us a few more details about that. Now, what they're doing here is saying, what percent of the value that we just got done calculating was based on future cash flows from that constant growth model? 93%. So years 1, 2, 3 only had 7% of the value. 93% of the value of this company was from the 5% growth after year 3 and forward. It says for the average company, it's about 80%. Okay, so long-term versus short-term focus. Why focus on quarterly earnings if most values derive from long-term cash flows? So the challenge with the stock market, and you see this a lot if you follow the market or if you follow daily business news, when you have earnings season. So, kind of think towards the end of every quarter of the year, you'll have about a 2 to 3 week window where companies are reporting their earnings. And when they do that, they're always comparing their earnings to what was expected. And what happens is that investment analysts, think of investment analysts at brokerage firms, banks, and so on, they're always publishing estimates, what they think the earnings should be for a company over a given quarter. And so what investors do is they compare what were the actual earnings for the quarter for the company versus what the expectation was. And that affects stock price. And the reason it affects stock price is that's a signal. So changes in quarterly earnings can signal change in future cash flows, which affects stock price. So if a company exceeds expectations, the stock price goes up because the company is generating more cash. If the company does not hit expectations, then the stock price comes down because the company was not as much profitable and does not generate the same amount of cash. Okay. Also, there's a downside to that. Managers often have bonuses tied to quarterly earnings. They have incentive to manage earnings. So that's not necessarily good or bad, but it just means that management might make decisions based more on quarterly results than annual results. Okay, so then the biggest challenge is, how do we actually forecast future cash flows? They gave us the number, right? They just said in the previous example, we'll go -10, then 20, then 35, and constant growth after that. Well, how do we get to that number is the question, right? So generally what you do is you look at your sales and you begin to go, how will sales turn out for the rest of the immediate future? And you might be able to guess, the first 3 to 5 years individually, but at some point you just have to go with that constant growth model. That's really the only way to do it. So it says to forecast sales to grow at a chosen growth rate, forecast your NOPAT and your net operating capital as a percent of sales. So NOPAT is net operating profit after tax, and then net operating capital. Okay, so that's usually the way we do it. So let's take a look at a situation here. We've got sales of 2 million, and we've got operating capital of 1,120,000, and so that gives me a ratio. I can take my operating profitability ratios, my NOPAT divided by my sales, and my capital requirement is operating capital divided by sales. And it says the target weighted average cost of capital for this company is 9%. Okay, so what I can do is say, where am I at today, and what's my desired state, and use that to forecast the future. So again, I have to kind of make some future guesses. I'm going to think that my sales will grow kind of at a higher rate first. I'll go 10, 8, and then I'm going to go to a constant growth of 5. And my target weight of capital is 9%. So this is what I do. I go, my WACC is 9, my sales are 2, my operating capital is 1,120,000, and my growth rates are 10, 8, 5, and 5. My NOPAT to sales is always 4.5, and my operating capital to sales is always 56. So I then apply my growth rate. So I go, sales would be times 10%. My NOPAT would be times 0.045. My operating capital would be times 0.56. And my free cash flow is my net operating profit after tax minus my operating capital in today minus what that would be in T minus 1 and so on. So my ROIC is return on invested capital equals my NOPAT divided by operating capital. So now that I have this formulas down, just imagine this is an Excel spreadsheet, and now I can just kind of plug in my assumptions, right? So I have my growth rate first, and then my NOPAT is a percent of sales. My operating capital is also up at a growth rate, and then my free cash flow is my formula, and my growth in free cash flow is right here, and my ROIC is 8%. Okay. Now remember, with this forecast, we want a WACC of 9. That's what the WACC is. So that means that for this company to be profitable, my ROIC has to be above 9. If it's exactly at 9, that's okay, but I really want that to be above 9. So this comes back at 8, meaning that my return is less than my cost of capital, and that's never a good thing, right? So we don't want that. So in this example, this forecast will not work. So if that truly is what we think is going to happen, the next 4 to 5 years, what we have to realize is that situation is not tenable. That's not going to work for us, and we need to do something else to increase the value of the company. Okay, so this says estimating intrinsic value, and what that means is what's the true value of the company, meaning if we were to apply some valuation methods, what would we get as the value of the company? Okay, and this is just kind of going through some of the same methods we looked at before. Okay, so in this example, we've got a horizon value of $1,260,000. Okay, and that came right there. So we're looking at the horizon value. Remember that in this example, we're going to go with a constant growth of 5% after year 4. So we're just valuing that right here. We're saying that's $1,260,000, and then we're bringing that down to present value to get $893.08, and then we're doing the present value of all future cash flows. So remember, we've got years. The first few years, we've got exact numbers of what those are, and we're going to bring those back to present value, and then the sum of them all is $893.08. Present, and that's the horizon value. The present value of free cash flows and the value of operations is $958. Okay. Now, in this example, that's not going to work because ROIC is 8, which is lower than the WACC. So the capital is not earning enough to meet investors' required return. Okay, so that's kind of what that means for us. So in this example, this is not going to be good for the future. So the ROIC is too low compared to the WACC. Capital is not earning enough. Horizon value is less than total net operating capital. The current value of operations is less than the current total net operating capital. So ROIC must be greater than WACC divided by 1 plus the growth rate for horizon value to be greater than the net operating capital of horizon. Okay, so let's do some examples of using free cash flows to forecast the future. So now let's move on to using dividends instead. So now let's go ahead and look at a company that pays dividends. And the key with this one is, that, again, just like we used free cash flows before, now we use dividends as a proxy for free cash flows, and we use R sub S as the proxy for the WACC. R sub S is what's the required return on the value of a particular stock. So it works the same way. What's the present value of, right here, of an infinite stream? Well, it's hard to do that, right? It's hard to conceptually think that through. So there's a formula that will do that for us, and it's right here, okay? And this is very similar to the FCF formula. The P0 is the price of the stock today, which is a proxy for value of operations, equals D1, and D1 is a proxy for FCF1. And we divide by R sub S minus G, which is the growth rate. So R sub S is the same as the WACC, and the growth rate is the growth rate. And so what I want you to recognize is D1 is the same thing as D0 times 1 plus the growth rate. Now, we've previously looked at what we call the SML, the securities market line. And that's called the CAPM formula, CAPM, the capital asset pricing model, capital asset pricing model. And we use this formula to help us figure out what's the required return, meaning the R sub S, on a particular stock adjusted for risk, okay? So I want you to kind of remember what we've mentioned previously is that the market gives you a beta of 1, okay? So anything above 1 is riskier than the market. Anything below 1 is safer than the market. So in this particular example, this stock has a beta of 1.2. It's a measurement of risk. Above 1 is riskier than the market. So I'm going to plug in my formulas here. My risk-free rate is 7. My market risk premium, the RPM, is 5. The beta is 1.2. So I multiply that all out and I get 13%. Okay. So what that tells me is that because this is a riskier company, I need a 13% return. So when I calculate my R sub S, I get 13%. So I'm going to plug in for R sub S that 13%, and then I do the math and I get $30.29 as the value of my company. Okay, so we can kind of take that was, the P0 obviously, but now we can say, well, what's the value a year from now, and so on. So my dividend in a year after D1 would just simply be 212 times 1.06, the growth rate, to get 2.2472. I could divide that by 13 minus 6, and I get 3210, and so on. So I can keep on doing that and predict stock price for the near future. So remember that this R sub S was 13, and so we can always break out the yield of 13 into its subcategories of dividend yield and capital gain yield. So my dividend yield is the D1 divided by P0, the future dividend divided by the stock price today. I get 7%. My capital gain yield is the change in my price between a future year and the base year, being P0, and then I divide that by my P0 price, I get 6%. So makes sense, right? 7 plus 6 is 13. So the value, the total return is 13. The dividend yield is 7. The capital gain yield is 6. Okay. So the sum of the two is my total yield. So I can take the same formula and I can rearrange that and say I can calculate R sub S knowing that. So if I know my D1, P0, and the growth rate, I can rearrange the formula to go R sub S equals 13%. Okay, and the last little section of the chapter deals with multiples. And as I mentioned earlier, price to earnings. So I have to know my earnings per share. If I take the stock price, I divide that by earnings per share, and that's my PE ratio, which is a multiple. Basically, what that means is here's what I'm willing to pay for $1 of earnings for a stock. Okay, and then I can look at a company that's maybe privately held and say, you are a lot like this publicly owned company over here, and its PE ratio is X. So if we use that ratio for your company, we can find out what your earnings are and apply that multiple and say your company is now worth that amount of money. Okay. So the PE ratio, the price to earnings multiple, price of a stock divided by earnings per share. Using entity multiples, so the entity value is the market price of equity, the number of shares multiplied by the price per share, plus the value of debt. So it says here to pick a measure such as EBITDA, which is earnings before interest, tax, depreciation, amortization, sales, customers, eyeballs, just whatever, and calculate the average entity ratio for a sample of comparable firms. So what's the value of EBITDA, the value of a customer, and so on. Find entity value of the firm in question. For example, multiply the firm's sales by the value divided by sales multiple, multiply the firm's number of customers by the value of divided by customer ratio, and then that gives us the firm value. We then subtract it to get total value and divide by the number of shares to get the price per share. Okay. Now, it's not a good method often. So it does work, but it has challenges. It's hard to find a comparable firm quite often. Most big companies that are publicly owned do more than one thing. So I'm looking at a smaller privately held company that does one thing. I can maybe find companies that's competing with, but I'm just really competing with a division of a company, not the entire company. So that makes it a lot more difficult to use this method. But it's a loose proxy. It's something that we can use as kind of a ballpark. So it says here comparing the FCF model and dividend growth model. I've given you a lot of comparisons already. They're really doing the same thing. The challenge is that only publicly owned companies pay dividends, and the dividend growth model really only works when a company pays dividends that have a logical increase year over year, which a lot of companies do, but not every company does that. So that makes the free cash flow model really being the preferred one because it works no matter what. It can work for a privately held company, publicly owned company. Doesn't matter if we pay dividends or not. All we need are financial statements and a little bit of more information from the company, and we can compute its free cash flow and then make assumptions about the future. Okay, so it's a real one that works no matter what. So this one always works, which means it's the preferred method. So the last little bit about preferred stocks is called a hybrid security. It's similar to a bond in that preferred stockholders receive a fixed dividend, which must be paid before dividends can be paid on common stock. However, unlike bonds, preferred stock dividends can be omitted without fear of pushing the firm into bankruptcy. If you have bonds, you have to contractually pay those dividends, right? And repay the bonds when they mature. If you don't do that, the bondholders will sue you and can force you into bankruptcy to get liquidated. That's what they mean by that. Preferred stocks have no maturity value, and you can choose not to pay the dividends. Now, you have to catch up your dividends at some point in time if you don't pay a dividend. But the owner of a preferred stock does not get to vote for the board of directors. That's one downside to that. So the value of a preferred stock is really simple. It's just taking the dividend divided by the required return. So very, very simple formula. So anything that you get in the chapter about preferred stock will be very straightforward for you, I promise. So that was the chapter. As always, let me know if you have questions.